Hey, what's going on, guys? We are back with more housing market data. We have a story out of CNBC that says mortgage refinance demand jumps 19% after rates hit their lowest level since July. So we're going to unpack this article, and I'm going to tell you what I think is really going on here and why we're seeing this increased number of mortgage applications. But before we jump into it, please consider hitting the like button and subscribing. It helps grow and promote the channel, and I do appreciate your support. All right, so let's look at this article. We have homeowners that are looking to refinance. They are trying to find savings after mortgage rates dropped last week. So the conforming loan, your standard conventional mortgage product, dropped to about 7.1%. The points associated with securing that rate have fallen to just over about 0.5%. Now, this is according to the Mortgage Bankers Association. It's the lowest level we've seen since July. Now, we have Mike Frantantoni, the Mortgage Bankers Association Senior Vice President and Chief Economist. He said, mortgage rates dropped last week as incoming data points to a slowing economy and support a pivot by the Federal Reserve to begin cutting rates next year. So in other words, the mortgage market is essentially front-running the potential that the Fed will lower the Fed funds rate moving into next year. And of course, on a prior video, we talked about the probabilities of seeing rate cuts going into late Q1 and early Q2 has increased dramatically. He continued to say borrowers who have seen rates near 8% earlier this fall are now seeing lenders quote rates below 7%. Refinance volume picked up in response to this drop in rates, with a particularly notable increase for FHA and VA refinance applications. So this right here is the critical part that I want to talk about. These are loans that generally require little to nothing down. FHA minimum down payment is 3.5%. VA is 0%. You can put as little as 0% down. And these are actually loans that have a higher than usual debt to income ratio. For instance, the FHA will actually allow a back-end debt to income ratio of 56.99%, whereas with VA, there's really no cap as long as you're able to get a desktop automated underwriting approval. And so one of the concerns that I have with the uptick we're seeing in these refi applications is that the consumers or the homeowners are simply stretched too thin. Let's provide a little bit of context here. So we have this is out of Mortgage News Daily. This is the refinance index versus the 30-year fixed rate. So in other words, this blue kind of bar here in the background where we see some spikes and some peaks and some valleys, this is your actual refinance applications. And I want to be perfectly clear, we are sitting at record lows. In fact, if we go back, let me see, click on the max here. This data goes back to 1990 roughly, and these are refinance applications. You can see that we're actually sitting at the lowest level we've been at in, I mean, literally like multiple decades at this point. So even this increase in mortgage applications of 19%, which is up 27% year over year. That sounds like a really large number, but it's coming off historic lows in mortgage application volume. And that, of course, is because we're dealing with these higher mortgage rates at this time. So the benefit to the borrower is substantially lower. With that being said, where are mortgage rates on, let's say, an FHA loan? Let's just unpack that mortgage product right now. So if we have the average 30-year fix on an FHA loan, where we are today, according to Mortgage News Daily, is sitting at about 6.43%. Now, we saw a high here at about 7.44%, and that was roughly, 6-7 weeks ago. So they have roughly come down about 100 basis points. It's really a 1% drop from where we are today. So what would this actually mean for refinancing? FHA has a product called an FHA Streamline. And essentially, it allows them with very little documentation in order to drop the rate and lower the monthly payment. But there has to be a net tangible benefit to the borrower. In fact, here's some of the guidelines here coming out of HUD.gov showing what an FHA Streamline actually is. So it's the mortgage to be refinanced must already be FHA insured. The mortgage has to be current. Generally, it has to be current for at least 12 months. The refinance has to result in a net tangible benefit to the borrower, and the borrower cannot get any more than $500 cash back at closing. One of the things that I think is super critical about streamlined refinances is listed in this paragraph. I'm going to read it to you and then let's unpack it. It says, lenders may offer streamlined refinances in several ways. Some lenders offer no-cost refinances actually no out-of-pocket expenses to the borrower by charging a higher rate of interest on the new loan than if the borrower financed or paid the closing costs in cash. From this premium, the lender pays any closing costs that are incurred on the transaction. So let me explain what this means. What generally happens with an FHA streamline is that you're not allowed to actually roll the closing costs into the loan, a true FHA streamline, which means that the fees that are associated with that transaction have to either, one, be covered by the lender in the form of a higher interest rate and or paid cash out of pocket by the borrower. Now, in many cases, these borrowers are buying the home with little to no money down, and they generally utilize these mortgage products because in some cases they have a higher debt to income ratio, so a conventional loan product is not actually available to them. And so in many cases, they don't have the ability to come to the closing table with these funds to close, and they're forced to take a higher interest rate in order to realize that refinance benefit. Now, even when mortgage rates drop a full percentage point, it doesn't necessarily mean that you get the lowest interest rate available because those rates work on a scale. So if you have to take a slightly higher rate to get a lender credit to offset those costs, well, then the benefit becomes smaller. I worked up a quick scenario so we can look at the math here. Let's say you hit the exact top of mortgage rates and you want to refinance where we are today. So if we take your current loan at 7.4%, which is the highest the rates were about 6 weeks ago. Say we have a $400,000 loan. The principal and interest payment, not including anything else, will be $2,770 per month. Now, with rates having dropped to about 6.4%, that same scenario would give us a monthly payment of $2,502. So it's a savings of $268 per month. But again, this is if we hit the exact top and if we're able to get the lowest rate that's available on the rate sheet today. What I want to point out is that there are substantial amounts of costs that are associated with this. So in order for the borrower to actually take advantage of that 6.4% rate, they're likely going to have to pay title and escrow fees, lender origination charges. Maybe there's a point or a little less than a point associated with securing that rate. With a $400,000 loan amount, they could be looking at $8,000 out of pocket in order to save $268 per month. And if we just look at a quick calculator here, if that loan costs $8,000 to secure and you save $268, you have a break-even point of about 2.5 years. Now, that's not terrible. But I think what it comes down to is that the borrower has to be willing and able to come to the closing table with roughly $8,000. And $8,000 is a lot of money. And so you'd want to obviously confirm this with the mortgage professional. But my point being is that the more likely scenario is that they're having to take a higher interest rate in order to cover a substantial amount of those closing costs, maybe all of the closing costs, and then what's left over with the monthly savings. So I think the probabilities are higher that if a borrower had a 7.4% rate, maybe they're able to reduce it by about 0.5%. And so instead of $268 savings per month, they might be more likely to see maybe like $100 to $125 a month savings. Now, of course, that's not anything to sneeze at. Every little bit helps, but it's significantly lower than what we're actually seeing on the screen. My biggest concern for this is that I don't know that it will move the needle enough for the borrower to actually improve their financial situation that much. And that goes back to where their debt to income ratio was when they purchased the home. If they had a back end debt to income ratio over 50% and you reduce the rate a little bit and you save $150 per month, that's great. It's something, but it would still mean that that home is, relatively speaking, rather unaffordable, especially when you take into account things like utilities, maintenance, upkeep, and the general expenses that you need to operate the property. And so my fear is that the consumer, the homeowner, they are continuing to get pinched. And when somebody purchases a property using FHA or VA and they're putting little to no money down, it becomes very difficult to get out of that property. If they were in a position where they needed to sell that home and get out from under it because they were struggling with the monthly payment, they're gonna have a very difficult time doing that because the exit costs on a property, the commissions that you have to pay, the closing costs that are involved are generally gonna be anywhere from 5 to 7%. And hypothetically speaking, if they purchased a year ago or 2 years ago and home values have actually decreased a little bit, They might even be in a position where they have negative equity, making it nearly impossible to get out from under that property. Now, of course, the good news is that the lower rates do provide some relief for these homeowners, and I would encourage you to talk to a mortgage broker, a mortgage professional, look at your exact scenario, and then just do a cost-benefit analysis and understand clearly what it will cost to actually refinance, what the monthly savings will be, and then you can sort of do the math and understand whether or not that would be worth it. All right, that's going to wrap it up for today's video. Hope you got some value out of it. If you did, please consider hitting that like button and subscribing. Helps grow and promote the channel, and I appreciate your support. Take care.